Welcome back to Forex Jumpstart. Today we're going to discuss the fine art of placing protective stops. There are three key points to consider when placing protective stops in any trade. Number one, let the charts dictate where we should place our protective stops. Ensure each trade has a superior risk-reward ratio, and also consider the chart's time frame when placing these stops. Number one, let the charts dictate where to place the stops. Protective stops should be placed below support in long trades and above resistance in trades to the short side. Support and resistance levels should be drawn, again, by connecting two significant low and high prices. The third time the market tests and fails to break either a support or resistance line is when we should place a trade. In trending market conditions, when the market has a tendency to accomplish new highs or new lows, we should make every attempt to only trade in the same direction as this trend. For example, we can see in the following chart, in a range-bound market, the market establishes support by connecting two significant lows, establishing again our support level. Resistance is drawn by connecting our two significant highs, where the market the third time tests and fails to break above resistance, establishing a good place to sell short. Protective stops again should be placed below support and above resistance, below and above the high and low levels that the market was able to achieve during that period of time. In a trending market condition, in this case to the downside, resistance is established by connecting two significant high points, and the third time the market tests and fails to break above this downtrending resistance line, we may sell short, while protective stops should be placed above the recent highs at a point where we do not expect the market to trade to. In addition, we should always consider a superior risk-to-reward ratio. Now, each trade should give us a chance to make at least 3 times the dollar amount of our risk. In other words, for every $1 put at risk, we should have the potential to make at least $3. Limit orders to take profits should also be placed according to these chart indications. For example, on the same chart we can see, as support is drawn by connecting two significant lows, we should look to go long just above support, placing our protective stops below support, again at a point where we do not expect the market to trade to. Resistance should be placed according to our significant highs. Sell short just below resistance, placing our protective stops in this case above resistance, again at a point where we do not expect the market to trade to. In addition, we should also consider the chart's time frame. Long-term charts, which include daily and weekly charts, should use between a 100 to 200 pip protective stop, generally speaking. Medium-term charts, such as 1 hour to 4 hour charts, should use between a 50 to 100 pip protective stop, generally speaking. Short-term trades on 15-minute to 60-minute charts should use a minimum of a 25 to 50 pip protective stop. Again, in any chart, for example, on the long-term charts, protective stops should be placed 100 to 200 pips above the recent high or above resistance. On short-term trades, stops should be placed at least 25 to 50 pips below our significant lows or our suspected support level. Additional points to consider. Look for additional confirmation through the use of other technical indicators and candlestick patterns. Don't simply buy the market because it's near support or sell short because it's near resistance. Wait for the market to test support and then reverse back to the upside. Take partial profits in the middle of the range as well to reduce the trade risk and book in a small amount of profits overall. We thank you very much for joining us, and we hope to see you very, very soon inside the 4X Lounge.